Welcome to the What to Watch video update. This is a video that I do once a week where I look at all of the charts, and I have hundreds of them, and I pick out the ones that seem to be telling us something right now, and I put them into one of three categories: positive, negative, and those things we're just keeping an eye on. Now, we've had some really interesting things happen in the week with geopolitical events, and specifically as it applies to the markets, we're dealing with oil. And oil's really been going up, and that's causing inflationary concerns. Interest rates are going up. The market's been under pressure. We're getting some economic data, especially on Friday, that was weaker than expected with GDP. And we saw this number the first time, and then it came out again. They do a second estimate, and it was like growth was half of what we saw the first time this report came out, and that's not a good thing. And then to make it even not even more good was that the inflation part of that report, the GDP deflator, that went up. So given the geopolitical situation right now, oil's going up. Everybody's on edge. The market is still very emotional. There's a lot of fear in the market right now. You put all that together, and the positive list is pretty short this week. Now, we could bounce at some point. We still have support levels that we might hit and then come up from those. We have a few indicators that are oversold. We have sentiment that's extreme negative, and that's when we start to say, okay, maybe we're overdoing it. But because things are so emotionally charged, that can feed over into what's happening in the market. Now, earlier in the week, this past week, we were looking okay, and we were actually positive on the week. And then we hit Thursday and Friday, and those were not good days for the market and turning things more negative, but we may have overdone it. Or the market may pause a little bit right now and kind of gather itself together and then continue to go down. And we've seen more of a defensive shift. Now, the growth areas, that's really what drives the market up. They actually held up pretty well this past week. They didn't go up very much, but they didn't go down like some other areas in the market because we've seen a shift in character. Now, there's how the market was behaving for January and February, where growth and value were kind of moving back, and other areas of the market, cyclical areas, they were starting to show some improvement. And that's kind of why we were seeing the indexes really slow down, because the indexes that we follow are weighted. And so the big indexes, they're more influenced by if Google or Apple or Nvidia, if they go up or down. Well, those stocks have kind of slowed down, but then we had other cyclical areas and materials and industrials and things that tend to do better when the economy's doing well. They were really showing some improvement. Well, then on February 28th, we went into a different phase with the attack on Iran, with the US and Israel teaming up to try to take out the regime in Iran. And of course, Iran is an oil producing country, and so that's really wreaking havoc on oil prices, and oil prices are really going up, and that could be inflationary. And plus, there's just a lot more crazy stuff. I mean, it's been crazy all along anyway. Now it's even gotten to a different level of crazy, and that's putting the market more in a defensive state. So, what we were seeing in January and February is now switched over to a different kind of environment. We don't know how long this is going to last, and we don't really know how the outcome is going to be as far as the markets. But until the markets can stop being so emotional and every headline, every rumor, positive or negative, the market's reacting to, and then get back to a place where, okay, what's the economy doing? What are the fundamentals doing? What are interest rates doing? What are earnings doing for companies? What are we seeing in the charts as far as, are we tending to trend up? Are we tending to trend down? Now, it's never black and white. It's always gray. And that's why my videos are longer. I show a lot of extra charts because my whole approach to technical analysis, I call it the consensus approach, or the consensus method, or the idea is to take all the information that we can, and you can't really go off what reports you're hearing or what people are saying or opinions that are being expressed. I tend to throw all that out. I listen to other opinions, but I ask questions. And not that I'm really trying to actually get an answer to that question right now. It's like, okay, here's a question because I don't know where we're at right now. And then so we'll watch things as they play out and we'll find answers to those questions. But along the way, there'll be other questions that we have to ask. And we evaluate things based on what's happening. And it's just a continual process of asking these questions and then saying, okay, based on all of the evidence that we can see, it looks like we're looking more negative, or we're looking more positive, or we're probably going to stay about the same. So that's kind of in a nutshell the whole approach that I use. In fact, with this video, I always start it with a question. And it's not a question we know the answer to. It's what we're going to be looking for to see if we can get an answer. Now, when I did this video a week ago, it had to do with oil because that's really been the big thing that the market's fixated on. A few months ago, I show oil charts in videos that I do every day. Well, we just kind of look at it and then quickly go on to the next chart. We just keep an eye on it. Well, now that's come into the forefront. And then earlier in the year, we were really looking at gold and silver because they were really at what was happening. Over the last couple of years, 2023, 2024, and even up until the latter part of 2025, we've been really watching large cap growth in the mega cap stocks because they were really driving the market. And then there's some concerns coming in with AI and AI disruption. And so that's when we would see some concerns in that area. And I still have those charts and we're still watching those areas because the market never says, okay, this is what I'm going to focus on now. It's kind of not really a game, but you just have to get a feel for what's going on to the point where it's like, okay, this is what the market's fixated on right now. And that may last a while and then it shifts to something else. And then it shifts it's always shifting. And then whatever news is coming out, sometimes good news is treated as good news. There's other times when good news is treated as bad news. And then the inverse of that can be true as well. We get bad news and that makes the market go down. But sometimes we could get bad news that the market likes and we actually go in the other direction. And you only get that from getting a feel by what you're seeing. And I always watch the markets while they're open. I'm not a day trader or anything like that, but I do watch 10-minute bar charts to kind of get a feel for what's happening during the day. And those feed into the daily charts. And that's where I make most of the evaluation and decisions from are daily charts. But then you go to the next level above that. You look at weekly charts and even some monthly charts, because then we get a bigger picture approach. So you're coming down from the bigger picture, you're coming up from the intraday picture, you're landing right about in the middle, in this case, on the daily side, because that's what I've felt over the years. And I've been doing this for decades. I'm into my fourth decade of really being a student of the markets. But not only am I a student, I'm also an educator. And I'll tell you about a program I have here in just a moment. But it never ends and it's always changing. In fact, I have a couple of new charts that I will actually show in this video, but then they're going to be incorporated into the daily and weekly videos that I do. And I'm always looking for some new way. Okay, how can we look at this chart? How can we look at this market? How can we see what's going on in this area? And then that feeds into, okay, let's now take all of that and evaluate it and put it into what we know. And I liken this to a degree. If you know much about history, I'm a history enthusiast. I also have a degree in history. I've been a history teacher, and I still really study history a lot. If you go back to the Cuban Missile Crisis, which was in 1962, and we got probably within minutes of an all-out nuclear exchange with the Soviet Union. It had to do with Cuba, which, yeah, we're kind of dealing with Cuba again now, even though most of the focus is on Iran. But, a few months ago, we're talking about Greenland. And then right at the beginning of the year, we're dealing with Venezuela. Now we're switching more over to Iran. Don't be surprised if Cuba comes back on the scene at some point, too, because there's a lot of changes going on there. And that country being so close to like Florida but to the U.S. itself, we need to keep an eye on what's happening in that part of the world. Well, the president during that time was John F. Kennedy. Now you can say what you want about him. Was was it a conspiracy when he was assassinated? Did Lee Harvey Oswald act alone? That's not what I'm talking about. But one of the things is I study presidents. I usually do it historically, meaning that, like right now, I wouldn't be reading a book about Biden or Obama or even George Bush, George W. Bush. That's too soon. Enough history, enough time needs to pass to go back and look at the context of what was going on there. Can't really do that with the markets, but one of the things I've learned about JFK over the years is when he was dealing with the Cuban Missile Crisis, which it's like, oh my gosh. And then the Bay of Pigs happened, and that was a total mess there, and he had to apologize. And looking back, a lot of it wasn't necessarily even his fault. He kind of got fed some bad information from a plan that he didn't even know about that now he had to take control of once he became president. Okay. But as we were navigating through the Cuban Missile Crisis, 13 days in October of 62, he was asking anybody and everybody, what do you think? What do you think? Not because he didn't know what to do, it's just he wanted to get every particular angle that he could and say, okay, maybe I haven't thought about it quite that way. Or maybe, okay, I've seen that evidence by what you're saying here. Now that kind of confirms what I was already saying. And then he would take all that information together. And in one of the most dangerous times in human history, we were able to navigate through that. And I've always studied that. I've always been fascinated with that. And so that's the approach over the decades that I've been a student of the markets. That's what I've incorporated my analysis into. And now, at the same time, I'm not only a student of the market, I'm also an educator. I'm trained and experienced as a lifelong educator. And that's what I'm trying to do with these videos. I'm not a money manager. I'm not a hedge fund manager. I'm not some kind of a guy who has the secret to all this figured out. But I do have a lot of years of experience and I know what works and I know what we need to keep an eye on and I know how to get a feel for the markets. And that's what I try to do through these videos. Even though this is a passive video that you view, my goal is to actually help teach the skill to you. And that's what I have a program for, and I'll explain that. But what we're asking this week, and we asked a very similar question a week ago because it had to do with oil then. This week we're asking, will oil keep the S&P 500 volatile? If oil keeps going up and moving around all over the place, that's going to have a direct impact on the markets. And this is being prepared for Monday, March 16th. So that's a little bit about me, but let me just very briefly tell you about the program that I have here. It's called the SPX Investing Program. My analysis comes down to the index level in general, and then I focus on the S&P 500 because there's all kinds of strategies you can implement. You can do short, intermediate, and long-term strategies all at the same time. You can even contradict yourself. You might have a longer-term portfolio that you hope the market's going to go up, but there might be short and even intermediate term times when you can make the money. Because at first I teach you how to protect what you already have. That's my number one rule. Don't lose money. And nobody should ever lose money in the markets, especially when you're dealing with the S&P 500. There are not really complicated things that you can learn how to do so you protect what you already have. And that's where I come from. Then rule number two is, okay, now let's see what's going on. Can we make some profits in the short and even in intermediate term, even if those moves contradict with our longer term portfolio? We could have a long-term portfolio that we want to buy low and sell high and have that build over a period of time. But then the markets go up and markets go down. They go up about 70% of the time, but there's about 30% of the time when they go down. And you can still keep your long-term portfolio intact, protect it, hedge it, while at the same time now making some profits in the short and intermediate term. And that's really what I do in the program. So if you're interested in learning more about that, I'd love to talk to you. I set up either Zoom calls or Google Meet. Skype's kind of gone by the wayside these days, or through email or what have you. I do this to educate people. So even if you're not in a program, even if you like talk to me and say, "Oh, yeah, he's a nice guy. I kind of liked him and everything," but nah, I don't think I don't care. I like meeting and talking to people and getting to know people and then just saying, "Okay, maybe this is something for you." And then you'll ultimately decide whether it is or it isn't. Well, in the program that I have, and it's a full-blown program, and but for right now, it's still free. So check it out. All you need is an email address. Now, there is a little bit of a catch there because it's set up on Substack. And even though I'm not charging anything, and I don't know when I'm going to start charging, it's kind of, let me just put it this way. I don't need to be doing what I'm doing here. Okay. What I want to do though is educate folks in these things. And I want to build that over time and I want to do it the right way. At some point, I will be charging for this. But in the meantime, check it out. The catch that I talked about is because it's hosted on Substack and the way I have things set up there, but there's also another way I have things set up too, and that I'll mention. I do need your email address, but and if you go to the full blown website, I have this website and then some sub websites underneath that to go off in different directions because it's kind of like I'm trying to be one size fits all because I have different things that I offer, but you might only want one part of those things that I do offer. But if you want everything, that's called the SPX Investing Program. It's the full program where you get all of the videos. Now, I do videos every day, and if you belong to the program, you get access to those videos right when they're available. And they're time sensitive. They're meant to be viewed before that particular market session. And so I really work hard to get those uploaded and available way before the market even opens to give you some time to look at that. But I do daily videos. I do a number of videos over the weekend. This is one of those weekend videos. I have courses that I've developed. I designed all the courseware myself. And if you don't know anything about the market, I've got a basic course, and then we build on that over a period of time. And then every day I do go through and say, okay, based on where we're at right now, these are some trade ideas. I don't tell people what to do. I just say, okay, based on what I teach in the program, this is the plan that the program is coming up with for this day. And then you take that program and then make it your own. You might not do it. You might do more of it. You might come to a slightly different conclusion than what I'm coming to with the program. But the idea is to put you in the driver's seat, not just to say, oh, buy this, sell that. When it comes to the stock market, people, for some reason, they want to be told what to do. And they think that somebody else is always the one with the answer. It doesn't work that way. If you want to have a consistent pattern of success and really build a successful program, you got to get to the point where you're thinking for yourself. You can't be relying on other people because they don't have as much as integrity with your money as you do. So that's it. And so I implement what's called critical thinking. I don't tell people what to do. I say, okay, based on what we teach in the program, here's a plan to start with. Now you take that plan and then you make it your plan. You adjust it to where you're at, what your emotions are doing, what your time schedule is like, and then going from there. And then you can set up one-on-one times with me, as I mentioned. There's also times when I do group things where we get a number of people together and we kind of have a little group type session. And then now, even though I focus on the S&P 500, the things that you learn in this program can be transferred to other areas. For example, I deal with the S&P 500 and I use a lot of technical analysis. So it's like, well, why would I want to do that? I want to get these hot stocks and buy them. Well, the skills that you learn in this program, you can transfer over to other areas in the market. So in that way, it's you're building skills that are transferable. And if you do those kinds of things, I don't deal with them directly in the program, but with the coaching part, let's set up a time and talk. Let's go through some of the different things that you have and just say, okay, have you thought about this? Have you thought about that? I won't tell you what to do. I'll just say, think about this, think about that. I also have newsletters that I put out every day, and I have a weekly newsletter as well. And then I do a 4, 5, 6 minute podcast each day as well. And the idea is I know my videos are longer, and people are like, hey, so much information out there. I understand that. But if you really want to know what's going on, you got to take the time to really study it. And I try to whittle down what you really need to know. But I also built it in kind of a pyramid fashion. And then, okay, every day it's like, okay, I got my meeting, I got to go to work, I got soccer practice for the kids, I'm going out to dinner with some friends, whatever. So I do the podcast. It's usually 4, 5, 6 minutes, and you can listen to that and go, okay, well, all right, something interesting's happened in the market. And then I also put out a daily newsletter that might take a few minutes to read. It's like, okay, I'll read through the daily newsletter. Okay, so I might be getting to the point where I need to make a decision, to either get in or get out of the market, or either we're going to go up or we're going to go down type of a thing. So now you've only taken a couple of minutes every day at that point to kind of get an idea where we're at. Then it's like, okay, maybe I better watch the full daily video. And those can be 40, 45, 50 minutes sometimes. Yeah, I know they're long. It takes me a long time to put them together. I put a lot of effort into those videos, not just to be some kind of a martyr, but to say, okay, this is where we're at right now. And we really need to be watching these areas, or we need to be careful of things, or we're looking pretty good in this other area here. So then you can take a little bit more time to get some more information. And then that's kind of the idea, is that I know you can't watch every video every day. You're busy. You have a real life. That's why I start off with the things that are only a few minutes, like the podcast or the daily video. And then I go from there to say, okay, now you might need to spend a little bit more time trying to prepare where we're at. Now, once I do get up and going, it'll be $97 per month, which is like cheap. Okay, there's programs out there that charge way beyond this and give you just a fraction of what I try to do here. I'm a committed educator, and that's really my calling in life. But it would be nice to be compensated for the time that I do spend doing this. And so I charge something, but I could charge 10 times this and still be justified. I'm not doing it for the money. I'm doing it because I'm an educator and I want to help people. It would just be nice to get a little bit of money to be compensated for all the time that I do spend. So if that interests you, go to this link here. It's also right below this video. Check it out. It's free. There's zero risk right now. But I forgot to mention the one hang up if you want to join the full-blown program is, even though that you're not charged anything, you still have to give payment information. Now that's a Substack thing. That's not my thing. And if you sign up, immediately I see that information and I switch you over to a free account. So even though you have to provide that information, you're not going to be charged anything. And then if you do find, hey, this is a pretty good program, I like it, you'll get plenty of warning when all of that happens. I'm not just gonna, come up out of the blue here. And then if I do switch things over and because I can tell how active people are too. And if you're just not really active in the program, I'm probably just going to say, okay, bye bye. Because I want to deal with people that really want to interact with me and what I'm trying to do here, not just be zombies and say, oh, well, I joined this on Substack, but then I've never really been back ever since. That's not doing either of us any good at this point. So, man, I got long-winded on this. Usually I just spend about 8 seconds on this. Now, if you don't want the full-blown program, but you do like the videos that I do, you can get them right when they're made available for $19 a month. But that's free right now, too. And then there's the delayed videos. Now, right now, the delayed, in fact, always, the delayed videos will be free. Now, what's the difference? Well, the videos that I make them before the market opens and they're meant to be viewed. Now, all of the decisions that we make in the program that I teach, we make right going into the close. So it doesn't mean you have to watch the video before the market opens. Maybe your schedule doesn't allow for that. So you might watch it maybe the first hour or two, maybe during lunchtime if you're on the East Coast, you can watch the video because all of our decisions are typically made, at least to get into positions, they're made right going into the close. So you have until about 4 o'clock Eastern or 1 o'clock if you're on the West Coast or whatever day it is if you live in a different part of the world. But then right after the market closes, all of the videos that I have, they go free at that point. I used to post them on YouTube and Rumble, but I was just saturating those channels and really not getting much traction there. So now I just put them on the website that I have. And here is the uh, link to that. That's also in the description below the video. Now, if you only want the newsletter, what I do after I do every video, I just take the whole transcript. I set it, I put it into AI, and then it spits out a summary of what I said in the video. Then I go through and I edit it, and then that's a newsletter that's made available, so you can read through that pretty quick. And that's free for right now, but it will be $8 a month once it gets up and going. And then there are some free aspects. I do put some additional videos up. I might post some articles. I might just things, especially right now with all these geopolitical things going on. There might be additional things that I post there, and that's just free. And I make it available to everybody, whether you're a full-blown member or not. Okay, and then here's the podcast as well. Now, if you join the delayed site where the videos become available right when the market closes, you still get access to the daily podcast right when it's recorded. That's kind of a little extra that I've thrown in there. That's not delayed. You can watch that. I used to post that on YouTube and Rumble, but it really didn't get a lot of traction there. So I decided just to put that on the website. All right, now let's stop all that stuff and let's go in and look at what's positive. But it's a pretty short list right now here. Now, one thing after Friday that actually did turn positive is a thing called the Swindling Trading Oscillator. And even though we had a down day and we were looking pretty negative after Thursday, it picked up something that it liked. And so we're actually turning back up here based on price and volume. So that's why this is on the positive side. Now, I don't treat this as one of my primary indicators. I put indicators into different categories. I have primary indicators. Those are the ones that I really look at and actually use those to make decisions. And I go through that in my technical analysis course, which ones those are. And then I have secondary indicators to say, okay, I don't really make decisions based on these charts, but are they confirming what I'm seeing in the primary indicators chart? And then there's this kind of weird area that's right between primary and secondary. That's what this indicator is here. It's kind of right in between. It's still important. I still look at it, but I don't necessarily make decisions based on this. But it's still a very important indicator as well. And that's what the Swindling Trading Oscillator has become for me. That's positive. And then our smart money indicator, I have three of them. One of them here is actually negative. Theirs was actually some buying that came into the market on Friday, enough to push the histogram up. Now, what I use to determine if this is positive or negative is I follow the red line, which is a 5-period exponential moving average. If it's going up, this indicator is positive. If this is going down, it's negative. Now, we're kind of bouncing around right now, but after Friday's session, we had enough of an upward move with the histogram, which is the green bar, to actually turn this up a little bit. So this one is positive. Unfortunately, the other two smart money indicators that I look at are negative right now. And then this is longer term. This is a weekly chart of the ratio between the NASDAQ 100, which is growth, and the Dow, which is, yeah, there's some growth stocks in the Dow, but they're considered to be the highest value stocks. And we do a ratio between those, and this ratio is actually holding up pretty well. The red line here goes back to the previous high set right during the dot-com boom and then ultimate bust. And then we came right back to this level at the end of 2021, and that's where we topped out. And then we went into a bear market in 2022. Well, we're still above this red line here. And so that's why I'm treating this as positive. And then another ratio, going back to the dot-com boom and ultimate bust, this is the QQQs, the NASDAQ 100 to small caps. This is still above the previous high as well, so I still treat that as positive. Semiconductors to Dow. Now, semis have been holding up fairly well. They got hit a little while ago, but They didn't have a really bad week this past week. And then the Dow's been under a little bit of pressure with all the geopolitical things happening. And so this ratio is actually holding up quite well. Again, here we have the highs set during the dot-com boom and then ultimate bust. We're still well above that blue line for right now. So I'm treating this as positive. And then this is a newer chart and it's longer term as well, even though it's a daily chart. This goes back a little while. And the interesting thing about this is it's a ratio between large cap growth. When growth, that's where the market goes up, is when growth stocks do well. And even the large caps tend to do even better and they have more of an impact on the indexes. We do a ratio of that with the S&P 500 and then that's what you see here in this chart. Now, you go back to 2020, 2021, we came up to a high, went back, came up to another high, went back. This is like a double top. This is also acting as overhead resistance. Well, then we went into 2022, we finally bottomed, and then we started to come back up. We actually surpassed these previous highs. And then one rule of technical analysis is what was once resistance now becomes support because we went above that. You can see how we've come down to this area a number of times. And we've been getting close lately in 2026. Now, the reason why I'm treating this as positive, not because of the decline, but because we're currently holding at this support level. Now, we ticked down a little bit here in Friday's session, and we're going to be watching this. But as long as we stay above this blue area, this is going to stay positive. But if we break down below it, then yeah, we're going to turn more negative at that point. But for right now, we're still holding on to support. And then we look at a ratio between stocks to bonds. Now we're seeing some weakness here. When stocks are outperforming bonds, this is above the rainbow and the rainbow's going up and everything. Well, we've been seeing kind of a breakdown here. We're still positive overall. And when we see the S&P outperforming 3 to 7 year bonds, these are bonds based on price, not interest rates, then the market is anticipating that we will have a soft landing, meaning no recession. Well, that's kind of a little bit in doubt lately here. Oil's going up. What's going to happen with employment, which is still looking good for right now, but that could change at some point. And are we eventually now, because of what's happening, and is interest rate or is inflation going to become a problem? Are interest rates going to go back up? Is that eventually going to feed over into the employment situation? Then we could continue to see this coming down. So, but for right now, I'm treating it as positive because we're just about, well, we're a little bit towards the lower end of the rainbow here when you look at this ratio overall. And this is that same ratio, but inverted, where instead of looking at stocks to bonds, here I'm looking at bonds to stocks. And we have been underperforming with bonds here for quite a while, but now we're seeing a bit of a bounce here. So this is the same study, is just flip-flopped because sometimes you get a different perspective by looking at the same thing in a little different way. And then the seasonality right now is still positive. Now, the first half of March is like the second best performing 2 weeks out of the month um, for the whole year. The first half of July is the strongest. Well, we're now out of that period and we're going into the second half of March now, where it still does well, but it tends to not do well on a seasonal basis. Now, we just use seasonality as a guide because all these crazy things that are going on, that's what the market's reacting to right now. But we still look at this, and I look at seasonality in a number of different ways just to kind of use it as a base to work off of, realizing that it doesn't mean that's automatically what's going to happen. But seasonally, there are things that do happen over a period of time that we can kind of say, okay, this is what has historically happened. Are we going to see a similar type of play out this time? And unfortunately, this is the last positive chart, and I got a lot of negative ones here. Okay, we were down on the week. This is what I follow during the day is a 10-minute candlestick chart here. And we were looking pretty good on Monday. We gapped down because oil, everyone was freaking out about oil. It almost got to 120, then it came back down to 85. And somehow the market took that as good news because it'd gone from, we never did get to 120. We got just to below it. And we were only there for like a few seconds, and then everything dropped down from that. But somehow that made the market happy. And so we gapped lower because of all the craziness that's happening. And then we actually had a pretty good day on Monday. And then Tuesday, this CPI came out this day, and came in as expected. And this is when we set the high for the week. Unfortunately, it would be downhill from there. We didn't see much conviction on Wednesday. We're just kind of chopping, but still down nonetheless. And then Thursday, this is when things started to get a little more crazy. We gapped down and closed at the low. And then Friday, it looked like, okay, maybe we're going to get a nice little bounce. Well, 10 minutes, 20 minutes after the open, we set the high and we spent the rest of the day going down and pretty much closed at the low for the week there. And then we're looking more negative here. Now, on the positive side, though, we're still hanging out above the 200-day moving average. We're about 0.43%, I believe, away from that. Not very far. So this is support. Now, there's other support levels that you see here in this chart. We've lost that. All right, but we're still above the 200-day moving average, and that's a big deal to the market. So even though we've been declining, and this is considered to be negative, the positive thing is this is what we're going to be watching. If we do see more declines, what's going to happen on a closing basis with the 200-day moving average? Now we may come down while the market's open, hit this, and then turn and go the other way. But we could spend like up until the last minute uh, during this upcoming week, we could be below the 200-day moving average, but if we come back up and close on it or above it, then that support is still holding. So we evaluate that on a closing basis. All right, and then even with all the gyration that's going on, uh, we're less than 5% away from the closing all-time high that was set at the end of January. Now, we haven't been doing all that much here, but we haven't seen an awful lot of weakness. It feels like the market's been all over the place, roller coaster crazy, but to only be down 5% from the high based on what's going on right now, it's holding up fairly well. Now, this is on a closing basis. I have other charts that I look at that measure the intraday basis, the open, high, low, and close, and you get little different percentages, measurements with that kind of a chart. Now, this is not me. This is a report that comes out once a week. It's folks that make recommendations out there. It's called the Investors Intelligence Bull and Bears, and they do a ratio here. We had been quite positive not so long ago here. We were actually above 4, and we dropped down into the 3s. Now we're dropping back down and actually getting more to neutral for a reading all by itself at 2.25. This is actually a little bit more negative because we were higher and now we're coming down. So the context is this has been getting more bearish rather than bullish. And then sentiment, we're under 25. Now that's the negative part. And you can see how we've been drifting down. But when we get to 25 based on this chart, that's kind of where we look to see this bottoming. I mean, even a year ago here, when we were just going in the toilet because of the tariff tiffs, we hung down here for a while, but that's about where we bottomed out and then came up from that. And then we had a low reading back in November, and then we bounced up from that. We're getting to a low reading. Now, this could still go lower than where it's at before, or where it's at. It could go lower than where we're at right now, I should say. But we start watching this and saying, okay, maybe we're getting extreme negative here once we drop below the 25 level. And then the VIX, this is a fear gauge. When we're above 20, we get negative annualized returns. When we're below 20, that's when we get positive annualized returns. The further below 20 we go, the higher those annualized returns become. And we're pretty elevated here. And this is the closing value with the bar chart. And then here with the line chart. And then down on the bottom, this is the open, high, low, close. And you can see even at the end of 2025, we started to see the VIX creeping up. We weren't really seeing any problems up here, but we were creeping up. Folks were starting to get more defensive. And then it actually rolls over and turns negative once we go above 20. And we spent a bit of time now since the whole eruption of what's going on in the Middle East. We've been above 20 for that whole time. This is a longer term look at the VIX, where you see the VIX on this chart. And I usually only show it in one of the weekend videos that I do, but I wanted to show it here because there's a negative and a positive on this chart. The VIX is on here, but it's invisible. I plot over top of that a 50-period exponential moving average. When we're below 20, that's more positive longer term, because if we get above 20, the market's usually going down and seeing a more convicted downward move. Now we are coming back up here. That's the negative part, but we're still below 20. That's the positive part. So we're going to be watching this because if we do go above 20 here, that means that things are turning more negative. Because we can go through times here when we go up, but then we hit a bottom and then we start to come back down from that. But so we're negative in the direction that this is going, but we're positive in the fact that we're still under 20. And then this is longer term, and this actually goes back into 2025. This is a long-term equity put call ratio based on 253 periods because that's like the maximum number of days you can have as trading days each year. We started to go up last back in 2025, and we're continuing to go up now. Now, as a general rule, when this is going up, the market's going down. When this is going down, let's see, do I have that right? Yeah, when this is going up, the market's going down. When this is going down, the market's going up. It goes the opposite of most logic here. So there's some negativity longer term that's still in the market and still building, and we just want to keep an eye on this. And then now I look at the trend, and I use a number of different indicators. The one that's the main one is called the ADX, average directional movement. And here, this is short term. And the ADX itself is the black line. And when it's going up, and I put the moving average on here to give it more context, this means that we're having a strengthening trend. When we get above the static level of 20, that means it's a confirmed strengthening trend. And then we say, okay, is it an uptrend or a downtrend? We see the red line, that's down, green line, that's usually up, but the red line is way above the green line. So this is a short-term confirmed strengthening negative trend. Now we're seeing pretty much that same thing in the intermediate term. And this is the time frame that I focus on the most here. But we're also negative with a strengthening confirmed trend. And then a couple of newer charts here, because I've used just the ADX to determine the trend for decades. Well, I've always been on the lookout for, okay, are there any other indicators that I could use to confirm what we're seeing with the ADX instead of just using one chart? Well, this is the linear regression R squared. And when this is going up, that means the trend is getting stronger. But we're also getting, this works like an oscillator. It only goes up so high before it turns and comes back down. So this is getting rather extreme. But for right now, it's showing that the trend is getting stronger. Then another method that when this is going up, it means the trend's getting stronger. Now we're still above the moving average, and I put the moving average on here, not it doesn't come with the indicator itself. This is actually showing a little bit of a breakdown here. Now I still a little bit of weakness with the trend right now. I use the ADX. That has the ultimate answer. I use this linear regression R squared and the GAPO here. Those are more confirmation indicators because I'm forward testing these since they're newer to me. Linear regression is not new to me, but this GAPO thing, I hadn't heard of it until a month or two ago. And then we look at the weekly trend, that's starting to turn negative as well. And that's a concern because we've been coming down with the ADX. That means a weakening trend. Now we've turned up and crossed above the moving average. And now that shows a strengthening trend. It's not confirmed until it gets above 20, but we are negative since the red line is above the green line. And we're looking negative here. We want the blue line to be above the red line. That means growth is outperforming value. And we haven't been seeing that pretty much from February on. We've been seeing growth underperforming value. Now, this is holding up okay. This is large cap growth of value, and it's a 10-minute intraday chart. This had been going up here and actually holding up nicely. Well, even it's taken a bit of a hit right now. That's why it's on the negative side. Then I look at some end of day charts. Small cap growth of value, we want this to be going up. It's kind of going sideways. Mid cap growth to value, this is continuing to show more weakness, and we're not seeing an awful lot of strength with the end of day S&P growth to value ratio either. So that's a concern, and that's why it's on the negative side here. Now there we're getting kind of a mix here. When you look at the Qs to S&P ratio, we rolled over here, but we're still above an advancing moving average. But when we look at discretionary to the S&P, this is a growth area. We want discretionary to be going up. It's going down and underperforming. We were improving when we compare large cap growth to value, but then we rolled over down to the moving average in Friday's session. So most of this chart is more negative when you look at the second and third areas, and even a little bit of weakness in the area that's still positive. So we look at the large caps, that's what I focus on the most, rolling over to the moving average. But then we look at the mid caps, we're crossing down back below the moving average. We're coming down just a little bit above the moving average with small cap growth to value here. Another growth to value ratio. It's been stabilizing, but it's still negative overall since we're falling down below the rainbow. And we're below the 200-day moving average with large cap growth. This is what's causing a lot of problems right now. When this is really going up, that's when the market is a lot more positive. Now this is actually holding up, but it's still negative as well. It's a ratio from the S&P to staples. Staples, that's what folks get into, toilet paper and toothpaste, when the market's getting ready to go down. And that's what we saw at the end of 2021 going into 2022. Now it looked like we were forming a very similar pattern here, but then lately, with all the geopolitical things going on, this ratio is actually holding up. It's stabilizing a little bit. Now it could go back to going down. That's what we're trying to figure out, and we'll be watching that. But at least it's slowed down. But in the bigger picture, it has been declining. We spent a lot of time above the rainbow. Now we're below the rainbow. And then discretionary to staples, we want this ratio to be going up. It just generated a death cross and it's actually going down. And then some short-term moving averages here. We're below the 10, 20, and 30, and even the lines are starting to go down. This is in the short term. That's why we have a short-term negative trend. Then the alligator here, we're below all the moving averages. Now, this is called the alligator because the more we're moving, the wider these lines will get from each other, like an alligator opening its mouth really wide. So this is negative. And then I use a double and triple exponential moving average here, and they move pretty fast. Tells us, okay, what's the condition of the short-term trend based on 20 periods? It's negative now, since this is all going down and prices below both lines. Now, this is what I use to determine whether we're positive or negative in the short term. We're below the 20 period simple and exponential moving average. That's why we're negative in the short term. We get back above these lines, then the short term trend is considered to be positive. I use moving averages to determine that. Then we move over and we look at the intermediate term trend. It's also seeing a lot of vulnerability right now. And we're below the 50 period moving averages, and the lines are starting to come down as well. So we're negative in the intermediate term. Now we were hanging on to the 100-day moving average. That's where we bottomed in November and then came up. We bottomed here back in February and we're able to hold out above that. Well, since everything erupted in the Middle East, we've been having a difficult time staying above the 100 period moving averages, and we're actually breaking down a little bit. One thing I want to point out too is you see this R2, R1P, S1, S2. These are already on the chart before it happens, and these are pivot points. And we've actually dropped below the S2 pivot point here. So we're losing a little bit of support here with the S&P itself. It just happens it's on this chart. I could put this on a different chart. It doesn't just go with the 100 period moving averages. Then I put all of the moving averages together. It's been hard to read here because they're all jumbling up with each other. That's why I have the breakout charts here. You can see how we're still holding out above the 200-day moving average. But we're getting kind of far away from both the 20 and the 50. That's what the boom indicator measures. When we get a low reading below minus 100 on the 20 period, that means we're far away from the 20 period moving average. And price has the tendency to move back to that moving average. It's like a magnet or a rubber band. We're also starting to get far away from the 50 period moving average. Now we're coming down here and showing some weakness, but we're still above zero with the 200 period moving average study. And so then I plot all of that here together. We're negative in the short, intermediate. We're still positive in the long term, but we're only 0.43% above the 200-day moving average now. And this is some short-term moving averages. When they're on top, that's the red lines. We're really going up. And then these are longer-term moving averages, so they move slower. This shows more conviction. We're starting to see a little bit of negative conviction build here as the red lines now drop below the blue lines, and they're all starting to go back down. Anchored weighted moving averages, which you put them in a place and then they project forward, where other moving averages, the regular ones, you look at right now and then you count the periods going back based on the number of periods in the moving average. So if it's a 20 period moving average, you take the last 20 periods, add them all up, and then divide by 20. That's a simple moving average. An exponential moving average weights them a little bit closer to current prices. But we had been holding out here above these lines and we were going nowhere. I don't like to use the shorter term volume weighted lines. I like the longer term ones. They tend to be more impactful. Well, you see this kind of mustard colored line? We came down and hit that in November and then went back above it. We're losing that now. We actually closed down below it. So this is showing the market being a little bit more vulnerable. And then the advanced decline line, it's still positive in the bigger picture since we're above the moving averages, but we have been taking a hit based on price and volume. And then I have an advanced decline oscillator over the last 10 periods. We're getting extreme negative. Now that's negative in and of itself, but getting this low of a reading might mean, okay, maybe we're due for some kind of a bounce here. But we don't front run that because we don't know what's going to happen. We just say, okay, we're getting an extreme negative reading. There's a chance that things could turn and go in the other direction. And then we look internally at the new highs, new lows. We're going down with the 5-day chart and the 10-day chart. And it's more of a contraction of the new highs. We're seeing a little bit of expansion here of the new lows, but things have based on a moving average here, we are looking more negative. And then this is another smart money indicator. This is actually smart money indicator number one. And we're almost down to the moving average. If we drop below this, that's going to turn negative longer term. Shorter term, I have a thing called the boom indicator. That is negative, but we're below this green line, which I put on here, by the way, so there's nothing magical about it. That is getting extreme negative. Now, this was last spring when we were kablooey all over the place. But once we get down here, sometimes that's showing more of an oversold condition as well. Now, it could still go down lower, like we saw a year ago here, but it's negative in its context, but we're also getting extreme negative right now. And then this is smart money indicator number three, a Chaikin oscillator. It's declining and starting to cross below the midpoint. So that's turning more negative. After it had been giving us a very high reading, it was way overextended to the upside, and now we've seen a reversal in this indicator. And then the vortex, the red line is above the green line, that's negative. And we're getting an extreme reading here with the S&P McClellan oscillator. It gets extreme when we drop below this minus 60 level here. We bounced up a little bit on Friday, even though we had a down day, it ticked up. So there was some buying that came in, but this is still negative overall until we start to come back up because it is extreme negative. And so that feeds into this. The summation index based on price and volume, they're clearly declining. That's negative. And then we look at the broad market, the NYSE McClellan oscillator. That's also starting to get extreme negative as well. And then this is a different way of calculating things. It uses percentages instead of raw price data. This is also starting to get extreme negative. It's the McClellan oscillator ratio adjusted. And then the summation index, that's a little further out as far as time horizon here. We're declining based on price and volume for the NYSE. Momentum is negative. Now, if you go back earlier into February, we were coming down with the PMO, but we were still going up when we break this out based on price and volume. Now they're all going down with each other, and so that's more negative. And then there's a series of studies. These are all the PMOs inside of the S&P. We're extreme negative here with the PMOs that are rising. We're starting to get extreme negative with the buy signals, and we're declining and dropping below 50 with the PMOs that are above zero. These are all negative, but we're seeing extreme negative readings with the top two parts of this chart. And we're negative with the parabolic SAR daily chart, and we're negative with the parabolic SAR weekly chart. The dots are on top, and that's negative. All the momentum indicators that we look at, they are negative. All are drifting lower. And there's another momentum indicator here called the Koppel curve. That's also negative. And for 2 days, Thursday and Friday, we closed below the Bollinger Band here. Now that's negative in and of itself. But once this happened, it tends not to last for very long. And so something will have to happen to get us out of this extreme negative reading. Now, it could be that we go up in price. Now, the Bollinger Bands, they're more dynamic to price movement. It could be that the Bollinger Band is coming down and we might stabilize as far as price, but the Bollinger Band might continue to decline. And that could take us out of this extreme negative reading. Or it could be a combination of the two. The blue line keeps going down where we go up a little bit here with price, and that kicks us out of this extreme negative reading. And then this is a long-term oscillator, the daily special K, just like the serial. Back in the early part of February, we crossed negative here, and that's longer term. I don't show this in the daily videos because we didn't even get any signals at all back in 2024. And this is a weekly special K chart. It's rolling over, but it's still positive in the longer term. And then we had enough of a downward move. These are point and figure charts. These don't take time into account. They just say, okay, when the S&P's gone up by a certain amount, I'll draw in green X's. But if we've gone down by a certain point value, then I'll draw in red O's. Well, we see some more red O's here. And that could take an hour or it could take a year. Point and figure charts are not dependent on time. They're totally focused on price movement. So this is looking more negative. This is the daily chart and weekly. We also saw some red O's being drawn in here. We're seeing a quadruple bottom breakdown. We had been holding up at some support areas here, and now we're starting to break below that, and that's longer term negative. Then the percent of stocks in the S&P above their 20 period moving averages, we're not quite extreme here, but we're below 50 and declining. That's negative in the short term. We're below 50 and declining with the 50 period moving average. That's negative. We're dropping below 50 with the 100 moving average study. And we're just a little bit under 50 here with the 200 period moving average study. So all of these charts are now negative. And this is a weekly chart, which we're seeing the weekly bars starting to trail off here. We've been going sideways for quite a while. So this is more negative overall, but we're still above this pivot point for right now. And these pivot points are long term. So as long as we stay above this P right here, we're still considered positive in the bigger picture. Then we look at bullish percent indexes. These are the point and figure charts where I just showed you the charts. These are all of the point and figure charts inside of the S&P. Well, we're below 50 and declining, so that's turning more negative. We're also below 50 and declining with the NYSE bullish percent index, and we've been holding up a little bit better, but then on Friday with the Nasdaq 100 bullish percent index, we also dropped below 50. So these are negative. Seeing some weakness here with our advanced decline line studies across all the different indexes. Now, this is negative right now. It's called the ZWAG NYC breadth thrust, but we're starting to get an extreme negative reading. Now, this could still go down more from where it's at right now, but once we finally bottom and come up, if we once we bottom and turn within 10 trading days, if we can get all the way back up to this red line, that's a ZWAG NYC breadth thrust, and that's a very positive thing for the market. Now, we have one about a year ago when we were coming up out of the April lows. We saw an up thrust here, and that's been positive for the market. Now, we also went extreme negative a couple of times here back in 2025, but we never made it back up to the red line. So those were not valid signals. We don't know if there's going to be a valid signal here either. We just start watching it when it gets to this extreme negative reading. And then we're just a little bit above the 200-day moving average with the Dow, so that's a support level that's still holding. Where we're below the 200-day moving average with the Nasdaq, but notice this S1 support level, that these are pretty important for the Nasdaq. So this support is still holding right now. We break below that, yeah, it's going to turn it more negative. If we can hold here, come back above the 200-day moving average, that might mean that support is still holding. Nasdaq 100, we're still above the 200-day moving average, but what we see here, this S1 pivot point and the 200-day moving average are pretty much at the same place. That's like a double layer of support right there. And so far, we're still above that. So we're hanging on to that support level. And we're below the shorter term moving averages with the cube, but we're still above the 200-day moving average. So there's a positive side and negative side here. And we're drifting down a little bit. This is a trend line going back to 2009 with a weekly chart of the Nasdaq 100. We're drifting down here, but I like to look at longer term charts sometimes because it can feel like we're just going all over the place crazy. And then you look at a longer term chart and it's like, we didn't really move that much after all. And then this is the second level of QQQ stocks. We have the NASDAQ 100. Well, this would be the NASDAQ 100 to 199 area. And a lot of the AI stocks are in this particular uh, ETF that we have here. We lost the 50, but we're still above the 200. But this is treated as negative since we're below the 50 and have been declining. Small caps, they were seeing a lot of favor, but now we've switched the environment in the market, and now we're seeing a pullback in the small caps. And I have two small cap indexes that I look at. The S&P 600, this is probably the more popular one, the Russell 2000 small caps. We lost the 50-day moving average, but we're still above the 200 here. So, but that's been seeing more weakness. Now, small caps were outperforming, and then the whole eruption in the Middle East happened, and now we're back to seeing small caps underperforming. They don't do well in inflationary interest rate rising environments, and that's what the market's starting to be concerned about. And that's why we're seeing this ratio coming back down. This also measures small caps to large caps, where we've been seeing some weakness after we had been seeing some pretty good strength. Mid cap still holding out right at this S2 point for right now. So that support level is holding. We're underneath the 200-day moving average with the bank ETF. We want this to be doing better. It's just not doing all that well. This is getting a hit a lot because of the private credit with all the money that's being borrowed for the AI trade. And then we kind of call that now the AI disruption. What's that going to do to jobs? What about all these billions of dollars that are being spent? Are we going to see a return on that? A lot of unknowns. What's AI going to do? How's that going to change the economy? And in the midst of uncertainty, that area of the market gets hit. Well, since these banks make loans, they're not doing all that well right now either. And then we're below the 50-day moving average. This measures all the stocks. It's the total US stock ETF. We're negative in the fact that we're below the 50, but we're still holding out above the 200, and we're still in a longer term uptrend. All right, and then the FANG index, we generated a death cross here, but we came back up to the 50, and now we're having a little bit of difficult time breaking back above that. And then we're seeing a real disconnect here between the FANG index and the S&P. The correlation, it usually is up in this blue area. You can see how it's really breaking down right now. This actually went up because the FANG stocks this past week have held up better than the S&P did itself. And this is the Magnificent Seven, a short-term chart here where we're extreme negative with the RSI, below the midpoint and declining with the longer-term stochastics, dropping below the midpoint with the Stoch RSI. This is short-term. This is long-term, and it's a ratio between the Magnificent Seven and non-Magnificent Seven stocks. We're holding up above the 50% retracement level, but when we bounced, we hit overhead resistance at the 38.2% retracement level. So this is holding up for right now, but you can see how it's been negative overall going back to November. We set the all-time high right at the end of October, and that's where we started to find trouble after that. Semiconductors, they're negative because we're below the 50-day moving average with the Dow Jones Semiconductor and the SMH Semiconductor ETF. So holding up okay here with the semi to tech ratio. When this is really going up, that's more positive for the market. Weekly chart here, we topped out above this blue dashed line and we've been declining. And this is a weekly chart. And a lot of times when we see an extreme reading and then start to go down, that's where the more meaningful declines tend to happen. This is the SMH Semiconductor ETF. This is the Dow Jones Semiconductors. Also, after getting an extreme positive reading, now it's starting to decline. This is oil. This is what everybody's freaked out about now. Coming in at 99.31 as of Friday's close. It'll be interesting to see how it opens Sunday evening with the futures. But this is geopolitically driven because of what's going on in the Strait of Hormuz. Now, this is a new chart here. This is oil right here. And then we look, oil has its own VIX. Like there's the VIX for the S&P 500. There's a thing called the VIXN for the NASDAQ 100, which measures volatility. Well, this is the OVX here. And you can see we're just skyrocketing up here as oil's really been going up. And then we look at some ratios here. Here's oil on the top, and then this is energy to the S&P. Energy's been the strongest area right now. It's more defensive. And there's a pretty strong correlation between the ratio in the middle area and the S&P 500 itself. Going up here, when we look at another ratio from energy to 10-year bonds, energy's outperforming. This is the private credit area of the market. We look at the chart here, and that's been drifting down, and that's been putting some pressure on the market, even before things erupted in the Middle East. Then this is a ratio of the private credit ETF to the S&P, and it's underperforming. Now, the things that we're watching, want to keep an eye on weekly jobless claims, continuing claims. We want to keep an eye on volume. We were actually below average with volume on Friday. And then we have a number of different ratios, which really haven't moved all that much. That's the positive side, but they're not going up. That's the negative side here. This is a risk on to risk off ratio, high beta to low beta. Yeah, we're declining in the bigger picture, but once we got into March, we've been kind of stabilizing a bit. And we look at staples to tech. We want this to be going down. Lately, it's been going up enough to generate a recent golden cross. And then staples to the S&P, we want this to be going down. It's been going up, even though it's pulled back a little lately. And then utilities, when this is going down, that means the S&P 500 is underperforming utilities, which is not what we want to have happen in a positive environment. We've really been coming up with the 10-year yield. Is that going to be a problem? We've seen a real rise here overall. And then we're checking out some different inflation concerns and interest rates going up concerns. This is a short-term chart, and we really spiked up over the last week, really going back to the beginning of March. If this continues to go up, that's going to be a problem. Is this spike that we're seeing right now more short-lived and it'll eventually work its way out? Well, then we go out a little bit further, and we've been going up with this ratio as well. And there's a longer term view of this ratio that's also been going up. If all three of these charts keep going up, yeah, that's going to be more negative. But we haven't been given a lot of context yet, and we haven't changed the trend from down to up with these charts, at least yet. And we want to keep an eye on the risky to not as risky bonds. These are the spreads here. And we've been coming down overall, and that's a bit of a concern. If this keeps falling, that's going to be more negative for the markets. Then we look at the 3-month average of the VIX and then measure it with the daily VIX. We topped out at the end of 2025 and we've been coming down even though we bounced up here. And a lot of times when you see a spike and then a reversal here, a lot of times that will mark some kind of a top. Now we generated this at the end of 2025 and here we are in the middle of March and now the market's finally reacting to that. So yeah, there can be a bit of a lag here. And then we look at some different ratios where we were coming down with discretionary to staples and now actually holding up fairly well, going sideways. Then we look at an equal weight version because Amazon and Tesla are in the discretionary sector and they're such huge companies. Well, we were declining here and now we've stabilized. Tech to utilities coming down, look like it's stabilizing a bit. The biotech to healthcare, that's actually holding up fairly well, but the hotels to utilities, no, that's not looking very good. Travel is getting hit really hard because of the rise of jet fuel and the craziness going on, and so there might be less traveling going on. Then these are bellwether areas here where the semiconductors have actually been holding up quite well, where we're seeing weakness in the home builders. They don't like it when interest rates go up. Transports, because of oil going up, they're going down here. Retail has been taking a hit lately, and the regional banks are having some problems here, but they're not really falling off a cliff, but they are showing some weakness. Then we look at US, the international stocks, and it's not like US stocks were strong. They just held up better since the beginning of March than international stocks have. That's why we're seeing this ratio going up. And then what does the market think about inflation? This is a daily chart of inflation expectations. And yeah, we're coming up a little bit here, but we're not busting out to the upside with this chart. Then the dollar, we're seeing a strength in the dollar right now, which is actually negative for stocks. We got back above the 100 level, and then we're on the weekly chart, we're also back above the 100 level there. And if that keeps going up, that's going to put pressure on stocks. Then I thought this was interesting. This just shows the daily fire, ballistic missiles and drones. When we first started on the 28th of February, this is coming out from Iran whole lot, then you can see a consistent drop off here. And this goes into, I'm recording this on Sunday, the 15th. This goes as of Saturday, the 14th of March, a real decrease there. This is more just informational based on what's happening in the world. And then these are pivot points from Monday's session to give us some support and resistance areas. Then we have this thing called the Hindenburg Omen. Perma bears love this thing. We had the initial spike on January 29th. Then we've had some additional spikes here. And if we don't get any more spikes, we'll keep watching this until the early part of April. But it looks like things are happening right now because this is negative with the Hindenburg. I mean, you think of that. But if we do get another spike, then I'll readjust the dates here. Thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.